Okay, guys, hello. Can you guys hear me loud and clear? I think there was something wrong with my microphone, and now I have actually fixed it, so that's good. Okay, can you guys let me know in the chat whether you can hear me loud and clear, just to confirm this, and whether you can type in the chat, and we will be on our way quite shortly. Okay, thanks for the confirmation, Michael. Okay, so welcome, guys, to another episode of our webinar series. Okay, so today's webinar is going to be part two of the lesson of support and resistance. Okay, so remember last week we went over the key basic stuff of how to plot a support and resistance lines or areas, and we identified exactly what it is in a sense first, and then we went on to a live environment and plotted them together. It was nice to get some sort of feedback from you guys and some sort of interaction on what instruments you would like me to go over. We're going to do pretty much the same scenario in this webinar today. So we're going to revisit support and resistance levels briefly, and then we're going to go over how to plot a trend line, how to identify a channel, and we're going to do that as well on the live environment after we've went over the uh, basic kind of definition of what is it. Okay, so it's going to be an interactive kind of webinar today as well. So please feel free to send me in the chat box what kind of instruments would you like me to go over. We will go over them together. If not, I have a few of them that I'm going to pull up instantly and spontaneously, and we're going to do just that. Okay, so okay, I see people still joining. Welcome, welcome. So let's make a start. Support and resistance levels, part two. We're going to focus on trend lines and channels. Okay, so this is a quick risk warning and a disclaimer. You can read this at your own time. Let's not waste time on this. Okay, so this is in a sense an overview of what we will go over in this session. Okay, so this is the agenda for today. So if you can look on the left-hand side of the chart, we have charting analysis, two categories, and the other one is mechanical analysis on the right-hand side. Last webinar, we went over support and resistance levels. Today, we're going to focus trend lines and channels. Okay, all the other stuff are going to come up in future webinars, so feel free to join if you like, obviously. Okay, so brief recap of what support and resistance is. Okay, so support level, or much more easily comprehended as an area rather than a specific level. You heard me talk about this last webinar. So it's a level or area on the chart where buying interest is sufficiently strong to overcome selling pressure. Okay, so in a sense, there is a pile up of buyers at that specific area or that specific level that does not allow the price to fall onto lower ground. Okay, this is where support area is. Okay, so in a sense, a decline is halted and prices turn back up. Super simplistic, and a support level is identified beforehand as a previous retraction low. Okay, so we talked about retracements as well in the past webinar. We're gonna go over them with this webinar as well. So feel free to ask questions if you don't know what it is and what we're talking about. We are more than happy to clarify. Okay, but for the time being, I presume everything is super simple. Okay, so resistance is pretty much the opposite of support. So it represents a price level or an area where selling pressure overcomes buying pressure. Okay, therefore the price advance is what we call halted or stopped or turned back if there is sufficient uh, selling pressure. Okay, so a resistance level is identified by a previous peak, and we have gone over the live environment together. And remember, last time I used to plot resistance and support levels on only one point, and we're talking about extremes. Okay, those are appropriate areas where you can place support and resistance level on the macro kind of kind of framework that will help you to, in a sense, have a visual illustration of where would you expect, reasonably expect, the price action to stall. Okay, so that applies to both support and resistance levels. So you have a visual illustration on the right hand side of the slide. So as support area is an level in this kind of case. This is a line, okay, where you see price action bouncing from, okay, tested once, okay, failed to break below, tested, okay, rebounded to higher ground. We see the bears taking control over the price action once again, failing to break below twice, same thing, okay, 3 times, and the movement is kind of retraced in this kind of case, okay? So 3 levels, 3 touches is what most traders consider to be the most appropriate, if you would like, or the most valid. Some people like to work with 2 touches, okay? That constitutes support as well. 3 touches, obviously, more is better in this kind of case. 4 touches, even more good, okay? So the opposite case here can be made about resistance, strong buying pressure, price is halted at this kind of level, okay? Retraces, okay, to lower ground. Bulls have a second attempt at breaking this level. They failed for the second time. Another pullback, much deeper pullback in this kind of case, okay? Rebound, okay? Drive for the third time. Bulls are driving for the third time. The price action to higher ground in order to break this level. Miserably fail, and the price action retreats to lower ground. Therefore, we brand this as a valid resistance area or resistance level. Okay, so something else to keep in the back of your minds is that whenever a support or a resistance level is broken by, and this is the criterion here, significant amount. So we're not talking about making this, and about making a substantial kind of move, visually substantial kind of move. They tend to reverse their roles and become the opposite. So if failed once, failed twice, and then the third time you see breakout above this kind of level, this area that was formerly resistance now becomes support. Okay, so they have this kind of interchangeability to them. Okay, in other words, a resistance level becomes a support level once it's broken, and a support level becomes a resistance again once it is definitively broken. Okay, we're not talking about a small wick and an upshot and then pullback. Okay, so you need to have substantial break above and a closure above that level that was acting as a support or a resistance level in the past. Okay, so pretty simple. Let's move on to primarily today's focus. We're going to talk about trend lines. So trend, in a sense, is what we call the direction of the market. Okay, so market moves are characterized by a series of zigzags. If you pull up a chart, you're going to see exactly what I mean. And these zigzags generate a series of successive peaks and successive troughs. Okay, depending on the direction. Okay, we get what we call in the markets an upside kind of move, an uptrend, a downtrend, or a sideways kind of motion. Okay, so it is the direction of those peaks and troughs that constitutes a market trend. So therefore, these are what we look for on a chart in order to plot a trend line. And in a sense, the trend line serves as a visual illustration of where the market is headed. Okay, does not provide you with any foresight or any kind of clear indication of where the market is going to move towards to next, but still, you in a sense identify the trend. And the reason why we identify the trend is because there are 3 idioms that are widely used in technical analysis and more in general in trading, is that you often hear people say that you need to always trade with the direction of the trend. Okay, so once you have an established move, best thing to do is go ahead and capitalize on that kind of direction rather than just being ready to go against it. Okay, be a contrarian. That comes into future plays as well. If you start to identify and understand how these kind of moves work, Okay. Once you identify where the market, at what stage the market is currently trending at, once you get good at that, then you can start going against the market. For the time being, if you're a novice trader, please, 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 please stick with trading with the trend. Super simple. It's hassle free. And most of the times if you identify correctly where the market is headed to, you can capitalize and make some serious gains on it. Okay. So comparison to being a contrarian and waiting for market reversals and all that kind of stuff, it's much more costly. It takes more time to spot it correctly, enter the market accurate at a adequate kind of level, and manage your trade afterwards. For the time being, please stick with the basics. Okay. So another idiom that you hear a lot in trading circles is that the trend is always okay. Trend is your friend, so therefore that's why you trade with it. Okay. And another one is don't go against the trend, because you can get burned out kind of quickly if for example, you don't identify correctly a market reversal. Okay. So it's the safest option to trade with a trend. And these are kind of wisdom words, wisdom kind of parabolas that are used by traders that have been there and done that. They know better. Okay. So these are some unwritten kind of rules that are relatively good to abide by. Okay. So the concept of a trend is very important, as many traders rely on the existence of the trend in order to predict price movements. And once again, here you can extrapolate that we're talking about. Once a trend is established, you need clear evidence of that trend coming to an end before placing a contrary kind of view. So for the time being, once a trend, a primary kind of movement has been created, the best thing to do is assume that it's going to continue going that direction up until a point where you see clear evidence that no longer serves this kind of assessment. Okay. So next slide talks about what kind of types of uh, market directions you have. You have main three directions in the market. You have what we call upwards kind of moving market, downward moving market, and a sideways moving market. So they're pretty obvious. Okay. So we're talking about upwards trending market or instrument or asset or whatever that is. We're talking about making consecutive higher highs and higher lows. You're going to see that on with a visual illustration. When we're talking about a downward trending market, we're talking about lower highs and lower lows, whereas the sideways kind of market is the trading range. In other words, what we call a trading range. So you see a price action bouncing between two levels, two horizontal levels or lines, if you would like, and the price action is stuck between there, having no direction whatsoever. Okay, so if the market is not trading upwards or downwards, it's trending in a sideways kind of fashion. Okay, sideways motions or sideways phases are just that, phases. They're temporary. You can contextualize that as a temporary pause of the market. Okay, towards either direction. So it's a temporary halt of the price action where you see buyers and sellers trying to identify what's the most appropriate price for that specific instrument. So once those those levels, those areas, because we're talking about a sideways kind of motion, once those areas are exceeded, okay, either to the upside or the downside, then a trend is kind of established. Okay, so you can again, remember sideways motion as a temporary pause of price action. Okay, so trend lines are, in a sense, used to identify these very directional movements of prices. So we're talking either upside, which is upwards, downwards, or sideways, to, in a sense, mark a trend. Again, visual illustrations plotted on a chart in order for your eyes, okay, to look at that and say, oh, you know what, it's going that way or it's going the other way. Okay, those are the reasons why we use trend line. Okay, so the slope of the trend line or the trend can be used in order to grasp the rate of price changes. So a steeper, okay, price action, okay, steeper consecutive higher highs and higher lows gives you an indication that market obviously has a lot of volume and a lot of liquidity, and price action is primarily driven by the bulls. Therefore, you want to capitalize upon that bullish kind of momentum and strength, and the price action ensues and moves to higher ground. Opposite is also true for a downward moving market. So the slope of the trend line says a lot as well. Okay, and we're gonna discuss that and see that on the live environment. Okay, so the usefulness of trend lines are based on the principle that once a trend is established, okay, gets underway, it usually persists over time. Okay, mainly because once again we see that one of the two parties, the bulls and the bears, takes control over the direction. Okay, so in the absence of bears and in the strong presence of bulls, the price action of any given instrument is going to move to higher ground. And again, on the flip side, in the absence of bulls and in the strong presence of bears, price action tends to move to lower ground. And there are many other technical indicators out there, for example, ADX, which gives you a grasp, okay, of how strong the buying pressure and how strong the selling pressure is at any given point in time. We're not going to go into ADX today. We're going to do that in the future. Again, gives you a clear idea of who is dominating the price action at this point in time. Okay, if you put that on your chart. Okay, so again, trend lines can also be used besides identifying the trend as points where you can pay close attention to and manage trades. Manage trades meaning you can set that level as an area where you be exiting or an area where you be entering the market if the price action, for example, if the price action pulls back on an upwards moving trend line. Okay, so again, if this is not clear, please bear with me. You're going to see that live. Okay, so trend lines can be used to manage trades, identify entry and exit points by focusing on what we call trend line breaks. Okay, so once we see a trend line being broken, okay, for example, the price action does like this. Okay, therefore, this is an upward moving trend line. Okay, an uptrend line. Okay, if we see this, so a breakdown below this line we just draw gives you an indication that, you know what, the price action, the main direction of the market may be turning. If you see this, okay, and then a consecutive lower high, okay, this compared to this is lower, then you have much more confidence that the market is reversing, okay, and it's going to go the opposite way. Or if it does, for example, this, and it breaks here, but the next leg up is higher than that, that in a sense gives you an indication that may see some sort of price action, sideways movement somewhere in here, or it's going to extend to high ground, or you can treat that depending on the situation. Okay, so trend line breaks, obviously opposite is also true. If you see price action breaking above a descending kind of trend line, you have an indication that, you know what, the primary move of the market may be coming to an end or may have come to an end. You need extra validation, okay, in order to declare that the market is going to reverse from here and go that way. Okay, you need to see consecutive higher highs and higher lows. Okay, we're going to discuss that. And that is the importance also of the trend line. For example, if you see the market doing this, rising, coming down to this kind of level, which is an ascending trend line, once again, you can use this bounce for you to enter the market and capitalize on the main trajectory of the market. Okay, so this is what we call trade with a trend. So anticipating where and when the price action is going to pull back towards that already drawn trend line, and I wait for those moments. And when you see a confirmation that is bouncing from that trend line, Then you enter the market, go long, and capitalize on the main trajectory of the market. Okay, we will visit them soon. Okay, so that's how you use trend lines in a sense. That's an alternative way of using trend lines. The primary reason why you use trend line is to identify the trend. Okay, so what is we noted there are three categories: upwards, downwards, and sideways. Let's visit them specifically and see and define what they are. Okay, so an uptrend is in a sense a series of consecutive higher peaks, okay, or higher highs, depending what you call peak or high, same thing, and consecutive higher troughs. Okay, this is a peak. Okay, easy to identify, and this is a fresh higher trough. Okay, you can see that they are higher compared to the previous one. Okay, this is higher, slightly higher, higher, higher. Okay, so consecutively higher highs and higher lows. This is what an uptrend moving market is. That's how you classify where the direction of the market is headed to. Okay, so an uptrend line is constructed by connecting two or more higher lows. The line is extended into the future in order to act as support during the development of the trend. Okay, now it signals bullish sentiment. In other words, the prices are likely to increase, and traders look to buy the pullbacks near the trend line. Okay, I think it's super clear. If not, guys, please let me know in the chat. Okay, so a downtrend is obviously the complete opposite, a series of consecutive lower peaks and consecutive lower troughs. Okay, so a downtrend line is constructed by connecting two or more lower highs. Okay, so this is one, this is lower high, a lower high here. Okay, and that's why you connect the trend line on top of these lower highs. Okay, and in a sense, it signals bearish sentiment. In other words, that prices are likely to decrease. Okay, traders look to sell the corrective rebounds near the trend line. Okay, this is what we call a corrective rebound. Nice entry for a sell here. Okay, same thing here. Price action moves to lower ground, form some sort of not support, but still the main direction of the market stands kind of contained by the bulls, push the price action to higher ground, fail to break above the trend line, triggers a sell signal here. Okay, so this is the corrective rebound where you use in order to enter the market while after you establish where it is headed. Okay, super clear. So sideways trend is identified by drawing two parallel trend lines, okay, horizontal parallel lines, with one acting as support and the other one acting as resistance, hence the forming of trading range, what we call a rectangle. Okay, so the market is trading in a horizontal range with neither the bears nor the bulls taking control of prices. So it represents an area of indecision of where the market is going to trend towards to next. Okay, so traders usually buy near the end, for example, somewhere in here once you see the rebound, and have a target near the top. Okay, another area, another keys here, have a target there. Okay, exit, sell here, close the position and cover the position there. Okay, same thing, go long, have a target up there, doesn't materialize, this one does. Okay, yeah, you get the picture. Okay, sell at the top, have a target at support for an exit and cover your position. Okay, so traders usually buy near the lower end of the range and sell near the upper bound. This is what we just visually illustrated here. So what about a channel? So when a price trends between two parallel lines, they form a channel. This is what we say. But a channel has a distinction between what we call a sideways kind of channel. It has an inherent kind of direction in it. Okay, so you have higher highs, yes. And, okay, also you have higher lows. Is moving to the upside. Okay, but the price action is contained by another parallel line in a sense, which does not allow the price action to exceed it and do weird stuff with it, if you like. So it's in a sense an upwards moving trend line in this specific upwards moving channel with an addition of a resistance kind of level on top of it. Okay. But the main direction of the market is to the upside. Okay. So channels can be upward sloping, the one we just noted here, downward sloping, and horizontal. Horizontal is the basic one we just noted in the prior slide. So if the channel is ascending, traders can enter long positions near the lower bound and take profit near the upper bound. So enter here, exit here, enter here, exit here, etc. Much like in this kind of fashion we discussed here with the sideways kind of movement. But when you have an upwards moving kind of channel, like this example right here, you are primarily biased towards the upside. Don't forget that. So therefore, you are allowing yourself to have a much higher target, if you will, like above the quote unquote upper bound, which is called, which acts as a resistance because we're primarily upwards. We're biased towards the bullish side because it moves to high ground. Okay, so let's go over in a live environment and just go over a few examples for us to understand much more clearly what we're talking about here. Okay, so let me pull up a chart. So what do we have here? We have the chart of AMD, Advanced Micro Devices. So AMD, chip maker, US listed company, has found severe support over the past year or so, mainly due to the AI hype frenzy that was initiated back in early start of 2023, so almost a year ago, no more than a year ago actually, where we saw kind of some sort of positive sentiment surrounding the chip makers' capability in regards to the AI front, which was primarily driven by, for example, NVIDIA and many other chip makers, TSMC. You also have SMCI. AMD is another one. So we're talking about from what, a daily point of view? Yeah, daily chart of AMD. And let's go ahead and place some sort of trend lines in order to identify where the market is headed. Pretty obvious. You use, for example, the earliest one we have here. This is a valid trend line. Okay, started from there, found support there. Not that much here, but certainly there. So you have 1, 2, 3, 4 touches. More than enough, gives you an indication that the market is moving to higher ground. Let me switch to a log kind of chart to see. Let me adjust it to see if we have some sort of better trend lines. Okay, so is going to be one. Okay, so we switched from a regular kind of price depiction to a logarithmic. So it serves its purposes in under different occasions. Okay, this one might be super valid one. Okay, and you see. Okay, so you see initiated price action from down here, rallying of prices, and you have how many touches? Let's count this as one. Let me get this out of the way. You have this as being the second one. Let me see if I can. Third one. Sorry, guys. For some reason, it got me logged out for a moment. Fourth one, fifth one, etc. You get the point, okay? Up until this point, we saw 1, 2, 3, 4, 5, 6 touches, okay? And after that, we see this kind of trend line being interrupted. Okay, so it broke down below that, but not a harsh kind of pullback. Price action were contained here, so they formed another higher low. Okay, so at this point in time, the bias, okay, was for a sideways kind of movement. And we can, if we zoom in, you're going to see exactly what I mean, a sideways movement. Once the price action has broken below this, okay, ascending trend line. So here, this is what we call a sideways kind of moving market after, okay, the bulls have went way above their capabilities, and in the absence of bears, they said, you know what, the bears entered the picture and said, this cannot go on for any longer. They said, this is the time to start selling this, or you might have had some sort of exiting positions of long kind of holders of this kind of company. So the breakdown below, or okay, the price action smashing this kind of ascending trend line signals that, you know what, there is a period of pause that's going to take here, and we expected to see some sort of consolidation there, and this is what essentially happened with AMD. They managed to form another higher low and continued from there onwards. Okay, and also see that in the same fashion, the okay, once a descending, ascending, or a descending, in this kind of case, it's an ascending trend line. Once an ascending trend line is interrupted, okay, and the price action goes through a stalling kind of period, it trades within a close trading range, you have the same kind of properties as support and resistance levels have. So you can use a trend line as a support line as well to time your entries. For example, you had this second one here. The third time, you would expect to see the, let me, give me one sec. So let's do it 16. So once, let's zoom in this kind of area here. Once you see that the price action rebounded from that support, that ascending trend line, and it's heading to higher ground, you can enter the position there and have a target, for example, somewhere up there for the challenge of this former peak, and have this support, this trend line as a support area for you to exit your position. So in a sense, you play the retracements here. So you await for the rebound from, okay, this upwards moving trend line. You time the market nicely and extrapolate that the price action is going to move to high ground since it rebounded from this ascending trend line. And you set your sights on, for example, the former peak as an area where you would exit the position. This is a traditional lovely play. So a risk reward ratio of 3.6. My books is very nice. So why does he keep kicking me out? Okay, so that's one way to do it. Okay, also you can, in a sense, await for the next one. Same thing. Pull back towards the ascending trend line. Assume that you're going to find support. Prices are going to find support at this kind of level. Once you see the confirmation that the price action has broken, okay, this is somewhere in the 26. Once you see evidence that the price action has rebounded from this key area, this ascending kind of trend line, which acted is in the past as support, you can place a long order. After that, you have a stop loss near the touching point, okay, and have a target. For example, in this kind of case, we didn't have because it was uncharted territory. Or maybe, let me see, let's go further back. Does it coincide with the former peak? No. Okay. So maybe your target would have been somewhere in here. Risk reward ratio of 2 to 1, not that great. Okay. Since the price action is moving to higher ground, you can use, for example, moving the MACD for the timing of your exit. Okay. So entering the position here, for example, have a target up there. I know it's uncharted territory, and this is we're talking about this in hindsight. So let's be humble and have a target up there using this area, which acted is in the past as a resistance level we just saw. So a risk reward ratio of 1.9 to 2, not that good, but still, that's one way to play it. But you can play it much more nicely on the second retracement back towards the ascending trend line, which is the area here, coincides with the former resistance level that has turned into support. So this is a valid entry point in my eyes. Risk this much, okay, and have a target up there, which was the former peak. Risk reward ratio in this kind of case was 2.6. Very nice. Okay. I ideally go for 3 to 1, but in some sort of cases when it's super, super obvious that the upwards moving momentum is superiorly stronger than the selling pressure of the bears, you tend to stay a little bit more longer in this kind of position since you're bullishly biased. So that's one way to play it. But if you come up at this point, you see that the price action retreats to lower ground, but it breaks below this kind of area. Let's zoom in on this kind of trading range to see how you could have just capitalized on this kind of sideways or this kind of trading range, price action, trading within range. Okay, so we use this. Is that a spike? No, let's use this kind of area. So we note here that the price action, okay, comes here, rebounds from the same level. So we have some sort of confidence that the price action, if it retreats to this kind of level once again, maybe it's gonna rebound from, okay. And on the flip side, where do we see resistance? If somewhere around this area, maybe here as well, okay. And we look for these areas when we make projections, okay? So assume that price action will moving to higher ground. We see some stalling of the price action, and you see the breakdown below the ascending trend line, okay? An area, a line that was tested multiple times in the past and has managed to, and we saw the price action rebounding from, okay? So that's certainly an important indicator that maybe the trend is shifting or is undergoing a sort of halting kind of period. So the channel maybe uh, start to being formed. Okay. So once we saw once and twice, so rebounding from here, but finding resistance there, this area down here, these two areas more specifically, would have been nice for you to time the market, okay? Use the lower bound of the channel as your target, okay? And the upper bound as a take profit kind of order. So a risk reward ratio of 3.72, that's very nice. And see, in this kind of case, we didn't manage to go all the way up, okay? So maybe you would have exited the position somewhere in here, fearing that the price action is going to move to lower ground. So adjust accordingly. For example, by drawing a short-term kind of trend line here. So the failure to break that, it's not is something that you pay significant attention to. But the next retracement lower, it happens exactly like we wanted. Okay, so in a sense, have a target near the upper bound, okay? And enter the market right after you see 1, 2, 3, 4 bounces from this kind of level, the $73 range, and have the target up there. We didn't hit it within the channel, but as the price action formed another leg higher, okay, we hit our target with a 3.82 risk reward ratio. Very nice. And you would have much more confidence in your assessment that this is going to move to high ground, mainly because you see the 1, 2, 3, 4 times of support acting as it should. Okay. Plus the confirmation that break above this kind of short-term ascending trend line, descending trend line, excuse me. Okay. So from here, what do we see? We see a much more severe kind of pullback from AMD. Okay. So therefore, once this kind of trend line definitively was definitively broken, okay, we start to redraw a new one, okay, after we see a pullback. Okay, we're venturing into territory we have not discussed in the past. These can be called as speed lines. Okay, so the slope of the ascent has been not hurt, but has been impeded. This sharp ascent has been impeded, and now prices are rising at a much slower pace compared to the first initial kind of move. So we have that area acting as the first point, second touch, third touch, and fourth touch down here. All these, okay, areas have acted, okay, as potential entry points for you to capitalize upon the upside, because you get the confirmation after this retracement, okay, this sharp retracement, that the price action is going to continue moving to higher ground. And let's zoom in a little bit more, and you're going to see an influx of different parameters pointing to the same kind of end result and same conclusion. So this area acted as a resistance level in the past. It was broken above it, okay, and we got the confirmation that the price action is going to move to higher ground. We see the retracement of the price action, okay, the pullback of the price action back towards this level, and it fails the first time to break below it. Hence, we draw that kind of ascending trend line, okay? The second time, you see, okay, a nice higher low, higher high, excuse me, but another higher low here, and rebounds above, okay, this key level. This gives us confirmation that there is strong buying pressure here, and traders and bulls are eager to re-enter the picture after this short-term kind of dominance by the bears. So therefore, the most appropriate area or level that you could have entered this position using this kind of influx of different parameters would have been the break above, or the breakout of this above this kind of key short-term descending trend line. These would have been your confirmation. And for example, you could have set your sights somewhere up there as an exit position. Okay, you can clearly see coincides nicely. Okay, so this may have been your target area. So you were risking the risk reward ratio would have been 2.5. Okay, that's decent. You could have adjusted, for example, your stop loss at a much higher kind of level. So maybe less than 10% you would have risked in order to get what, 36. That's super decent in my books. Okay, so the optimal place that you could have entered and capitalized upon this would have been after the definitive break above this kind of descending trend line, after the formation of 2 consecutive higher lows, okay, and the break above this kind of area as well, which was the former peak. Okay, so somewhere in here would have been the most ideal place to enter this long position and capitalize on the upside. If you would have been, if you missed this kind of move, for example, you would have reasonably, if you have been watching this kind of price action, another entry point is going to be somewhere in this area here. Or if you were eager, you could have entered somewhere in here after the formation of a new higher low, okay, above this level. Okay, so if you missed this kind of rebound from these kind of prices, an ideal entry point may have been somewhere in here. The target would have been set using this former peak, for example, the next one, as take profit target. Would have risked, for example, 8% in order to get 34. Once again, risk reward ratio of close to 4% or 3.5%. Super, super, super decent. So that's another way to play this. Or await for the next definitive pullback close to this freshly drawn ascending trend line. Okay. And it would have been somewhere in here. Okay. After you see the price action breaking above this level. Okay. So plus you have at the same time a double bottom, if you would like. Okay. Or an area where you see the price action rebounding from. Okay. An ideal entry point would have been, in my books, once again, after we clear this area here, stop loss would have been somewhere in here, 10%, maybe it's too much. And you would have had a target for an exit somewhere up there. Okay. Because this is the former all-time high. This is definitely going to be some sort of resistance there. Apparently not. We have broken definitively above that. So in this kind of case, a risk reward ratio would have been 4.68%. Superb. Who doesn't want to risk 8, 9, 10% in order to get 50 or 40, 44, 40, 50? Super decent risk reward ratio. So it does worth your time. And finally, where we are currently standing still, because we're far away from this kind of long-term ascending trend line. Going long there is super, super risky. Therefore, we await for some sort of pullback. Okay. If it happens with AMD somewhere in here, for example, a former level that was acting as a resistance in the past, and it has found some sort of support here. If you look closely, 1, 2, 3 times rebounding from. Okay, so a strong buying pressure there, not allowing the bears to push the price action to lower ground. But since the price action has went ahead of itself, I'm not going to rush and enter a position there. Stop loss and the risk reward is going to be terrible. So I'm not going to rush in. I'm going to wait if and only if the price action pulls back to this kind of level. If it manages to find some sort of support, once again, up until somewhere in this kind of area, I'm going to play like this. Okay. So I'm not rushing to enter this. So if the price action falls from here, manages to form some sort of support there and does something like this, then I'll be biased to enter long here and capitalize on the upside. Risk reward ratio of 2.3, decent. Okay, not bad. Or you could have had some sort of expectation that it's going to be a breakout above this. If this is the fresh all-time high, I'm going to give it a little bit more room to run because we're still bullishly biased here. The momentum is definitely with the bulls. Okay. So that's one way to go at it. Hopefully, you guys understood how to use support and resistance levels, how to plot correctly trend lines. In this kind of case, we draw long-term trend lines, ascending trend lines. We draw also a short to medium kind of term, intermediate kind of pullback, descending trend line. In this kind of case, we found here a sideways trading kind of motion where you could have capitalized upon that as well. So all in all, we've done pretty much everything with using only one chart. So uh, as I don't see any sort of suggestions in the chat box of what to do next, I'm going to leave it here. We're already nearing the end anyways. So I see no questions in the chat. Let's close it there. So this has been the end of today's session, guys. Thanks for watching, and we'll catch you on to next week where we're going to visit technical indicators. We're going to do RSI and Bollinger Bands. For the time being, have a lovely weekend and see you next week. Take care. Bye-bye.